On today's segment on alternative investments, we will be providing an overview on private equity secondaries. While the secondaries market is mainly focused on private equity assets, other alternative asset classes such as real assets and private debt can also incorporate secondaries in their overall strategies. A quick review of a private equity transaction. In a primary private equity transaction, limited partners, known as LPs, commit capital to be invested by the general partners, known as the GPs. After funds are called and raised from LPs, there is typically a period of years where any redemptions are prohibited. This is designed to give the companies acquired by the GP time to build value for the LPs before a liquidity event is commenced. Selling investments on the secondary market is not new. The New York Stock Exchange has served the public equity secondary market since the late 18th century. Assets under management, or AUM, for private equity secondaries has grown at a compounded annual rate of 20.2% since 2000, outpacing the overall growth rate of primary private equity AUM of 12.9% over the same period. The main drivers of private equity returns, the use of leverage, appreciation in value of companies acquired over time, and the new cash flows created from these acquired companies of the PE firm all play a role in the performance of secondaries. Secondaries tend to avoid the J-curve period of negative returns of a primary private equity fund. The J-curve is a common occurrence in the first few years due to the delayed period from when the initial capital calls are made until the final capital calls when the GP has acquired the underlying companies for the portfolio. The returns during this period are generally negative and then can rapidly increase as the acquired companies build value. Since secondaries are generally acquired later in a primary fund's life cycle, this tends to limit further capital calls as well as shorten the time before an LP can receive distributions. Whereas investors in private equity funds often have little insights into the companies to be acquired by the general partner, secondary buyers tend to invest in funds with more mature companies that are generating consistent cash flows. As the secondaries market has grown and matured, three common types of transactions have emerged, each with distinct features. We will look at these features in a future episode.
If you should have further questions, please reach out to us via our website at konzaglobal.com. Until our next episode, please keep searching for ways to enhance your wealth.